Hello everyone, welcome back to part 2 of our discussion of chapter 6, continuing on with depreciation. There are depreciation methods, but the preferred and what the IRS really wants you to do is just use their tables. They're in your appendix to chapter 6, starting on 6-45. And basically, the way that you don't have to remember whether it's 200% or anything, you just need to know what the cost of or the basis is, and then you simply multiply it by the percentage. All those numbers in those columns are percentages based on the number of years. So in the first year, if it's 5-year property, you're going to multiply the basis by 20% or 0.20. That's how you do it. And if you just go down each year, that automatically calculates the half-year convention and the 200% declining balance and switches over to straight line. Okay? So you don't have to worry about any of those. Now, if you go over to the, as far as the straight line, you can use straight lines a little easier with, remember that's for real estate. They actually have on table 6A6 the 27.5 years for residential real estate and 39 years at the bottom of page 649. We don't use 31.5 years anymore. So you just need to know the year and then the month that you bought it in, and then you can use that. Again, these are percentages times whatever the cost is. Remember, on real estate, you have to take out the land because it is not depreciable. You don't depreciate land. That's the one physical real estate asset you do not depreciate. So, now that we've got that whole idea of how to calculate depreciation, now we find out some rules that will basically make depreciation only happen in rare cases and only really with real estate. And that is, there's two types of depreciation that are special in order to help businesses deduct more all at once. So basically, there's two provisions that basically allow you to, while you buy an asset that's going to last you 10 years, you can depreciate it all in this year you buy it, basically making it like any other expense. However, there are limitations to this, and the first one has to do with Section 179. In 2019, the maximum you can do that for is $1,020,000. So you can deduct immediately the cost of assets up to $1,020,000, as long as you are not going to create an NOL, meaning you can't have negative income from that business by taking that extra expense. Now, if your business buys over $5 million, $5.1 million of stuff, then you have to reduce this amount. But that, for small businesses, for most Schedule Cs that you're going to see, this is going to cover almost everything they purchase, as long as it's not real estate. So real estate cannot fall under this category and does not qualify for Section 179. Let's say that, and there's some other things like rental properties that don't fall, rental furnishings that don't fall under Section 179. There's also a 100% bonus. So for 2019, anything that has a 20-year useful life or less, it fits in the category of 3-year property, 5-year property, 7, 10, or 15-year property. It's fully deductible, 100%, with no limit. So you don't even have to worry about the $1,020,000. So Section 179 becomes even less important because of a 100% bonus. It becomes the best deal you got going. It used to apply only to new properties or new stuff you bought brand new. Now no longer does. Now, this is a temporary part of the tax law through 2023, and then it starts reducing. But for now, this 100% bonus can basically make our depreciation issues go away for everything. Again, does not count for real estate of either side, because remember, their maker's useful life is 27.5 or 39 years. Now, there are some special assets that the IRS thinks you're going to be more likely to abuse and depreciate when you shouldn't. Remember, you can only depreciate it for the business use. These are things that have both business and personal use, or could have both business and personal use. Now, you can have an asset and use a half for business, half personal, and you're only going to depreciate the half that's used for business. That's fine. That's all good and fine and dandy. But there are certain things like autos and boats that the IRS is like, we want you to list them specifically so that we know that you know that we're watching you to see if you really are using it for business. Okay? So if this is a case, if it's one of these types of listed property and it's used for less than 50%, you cannot take Section 179. So there's a restriction. All right? And if it's used for less than 50%, you have to use straight line. You cannot use the tables that we just described you're using. Okay? So there's a couple of, zingers there on these types of assets if the use is below 50%. So most people got to make sure that they use it more than 50%. And just know that autos, boats are the kinds of things that are easily used. So nobody's worried about using a backhoe for personal use. So that's not a listed property, at least not on a regular basis. But autos and boats, there's a chance to do that. They used to have cell phones on this list, and that came off. Thank heavens. Just in not really a good way to separate business and personal use on that. Now, we have this luxury automobile limitations you should be aware of. Autos less than 6,000 pounds. Okay. There's limits on how much depreciation. I don't care whether you use 100% bonus or the Section 179 or regular depreciation calculations. You cannot depreciate an automobile more than $18,000 in its first year, no matter how much you calculate, how much you pay. You don't care if you bought it for $160,000. Your depreciation for year one is $18,000. For year two is $16,000. Year three is $9,600, and for every year after that, $5,760 until it gets fully depreciated. So if you bought a $160,000 car, you're going to be depreciating it for a long, long time. Okay. For SUVs over $6,000, okay, you can only use Section 179 $25,000. So it's not the big number for Section 179, but it's not completely zero for Section 179 either. Okay. However, the bonus is not an issue. So you can take 100% bonus depreciation on these large SUVs over 6,000 pounds for as much as you spend on them. So there's kind of you might say there's a loophole for your big Suburban to buy and drive around. You can get that bonus depreciation all at once. Now, what if you lease a vehicle? There's some issues there. People said, okay, I'll lease it. If I can't depreciate my luxury car that I spent $160,000, I'll just lease it. If that's the case, then there's an amount you have to include in that's not deductible. So basically, if you pay $1,000 for a lease on it per month, some part of that, and it depends on the value of the vehicle and what year you own the vehicle, is not going to be deductible, and that's called the lease exclusion amount. And every year, remember, revenue procedures are the IRS anticipating amounts you're going to need, and so they give you those amounts every year, adjust them every year, give you a big like a table to use to look up how much is not deductible. So, transportation travel. Transportation expenses, while are deductible from going from one workplace to another, but that is really limited in the current law because there's no miscellaneous itemized deductions anymore. So if one of those workplaces is a Schedule C type of scenario, you could go from travel from your home office to a client's location or from one client to another client, and that would be transportation that we're talking about, would be necessary and deductible. Travel, when we refer to that, is when we're out of the area, we're going to need to go stay overnight. Typically, the IRS kind of looks at that as it's got to be 100 miles or more. And then we have the deduction for potentially for hotel and meals, that sort of thing. So really, we're limited here to visiting clients and customers. Getting from home to a temporary workplace is only deductible for very specified folks and not a general idea. Okay, really the idea here is home office to a client location. If you're driving to clients, if you're driving to see to get supplies for your business, that sort of thing, all of those could be deducted at a standard mileage rate of 58 cents per mile, or you can keep track of all your costs, the gas, oil, repairs, all of that type of thing. You may get a bigger one for actual expenses. Really depends on how good a gas mileage your car gets. If you are driving a Prius, then the standard mileage rate is going to be way more than your actual costs are going to be, unless you have a big repair or something like that. But if you're driving a Suburban, then your actual cost could be significantly more than 58 cents per mile, especially when you consider depreciation. And that's included in that 58 cents. So you don't get to take depreciation on top of that, but you do get to take parking and tolls are separate. They're not included in this mileage rate. Insurance is, but not personal property taxes or license fees. If you're overnight, you can deduct the cost to get there, lodging, other incidental expenses. Actually, IRS publishes how much you can deduct, so you can actually know the amount. You don't even have to keep track of every little meal receipt or anything like that. You just have to have documentation of why you went and for what period of time. And you can split a trip between personal and business. So if you go on a trip, as long as the trip is primarily to go to something business related, then if you stopped off and went to grandma's house or something else, you can split your time between the two. So if it was 5 days and you spent 2 days sightseeing and 3 days business, then you can split your cost of the hotel and things 60-40. You could take the entire transportation as long as that was the primary purpose for your going. Okay. Meals are now deductible 50%. No entertainment anymore. Expenses are deductible under the new tax law. Has to be directly related, associated with business, meaning you got to know who you were talking to during that meal about business, and you got to be doing business one after or before or something like that. And you can take us per diem again by just keeping track of how many days you're gone and why for $51. That includes, and you can look up higher cost areas. There's a whole, if you look up GSA per diem rates, It'll give you per diem for basically any big city in the United States and even around the world. You're not supposed to be able to be lavish or extravagant. I find the standard per diem rate being plenty for eating and such. I've never had any concern. It's actually always been more than I've needed to spend. So I wouldn't anticipate that being a problem. And if you're within the per diem, then obviously you're not lavish or extravagant, because that's what the IRS guidelines have been. All right, so that part 2, we'll come back and finish up the last, looking at our home office deductions and some other miscellaneous items having to do with self-employment.